All right, so let's continue our lesson on the financial markets. One of the financial markets that exists to deal with the problem of risk. Everybody has a certain level of what we call risk aversion. Risk aversion is a dislike of things that are uncertain. We think that if we do a certain activity and we don't really know the end result, that something bad could happen, and so we avoid it. And so in finance, people avoid things that could be risky in the sense that they don't want to lose their money. Okay, so a lot of times what I like to do is I like to start off by saying, what's more risky, okay? Jumping out of an airplane, with a parachute, of course, or going bird watching. It's likely that you would say jumping out of a plane. So for me, as an individual, I'm never going to jump out of a plane. You won't catch me doing that. That's just not something I'm interested in doing. I have a certain risk aversion to that. But for an individual that does jump out of a plane versus an individual that goes bird watching, there's going to be a definite different level of risk. However, there's going to be a different level of return, meaning when I jump out of the plane at 4,000 feet or whatever it is, I'm going to get a huge rush. It's going to be exhilarating. My heart's going to pump. My adrenaline's going to flow. The level of return is going to be higher than, let's say, bird watching. All right, so anyhow, if a person is risk averse, they will be likely to avoid certain things that could potentially bring them harm, like jumping out of a plane or like investing in a risky stock. Let's talk quickly about the trade-off between risk and return. All right, risk and return. There is a trade-off that exists between risk and return. In other words, the higher the risk, the higher the potential return. The lower the risk, the lower the potential return. So for instance, some low-risk investments would be something like a bond in the federal government, savings account, something that would be very, very low risk, but would also then in turn pay you a very low return. A high risk would be something that is potentially a high return, but it could also cause some volatility in the market you're investing in and subsequently lose your money. Something like a stock in a startup company, let's say, or real estate we've seen as a volatile industry. One way to avoid tremendous risk in a market is by diversifying. And so a lot of financial analysts recommend diversification because it helps reduce the risk of putting all your money into one asset. And when you diversify, essentially what you're doing is you're spreading those assets around. In other words, you're not putting all your eggs in one basket. So this can help to eliminate what we call firm-specific risk, in that we're not putting all our money into one company only to see that company fall out of favor with the market and maybe go bankrupt or what have you. So for instance, like investing in pets.com, putting all your money into that company, it goes out of business, you lose your investment, your total investment. So I would rather invest in multiple companies so that if one does fall out of favor, then it offsets the loss of one with the gain of another. Although we can't totally eliminate risk by diversification, we can again eliminate firm-specific risk, but we cannot eliminate what we call market risk. That is, if the market itself takes a downturn. So here's the definition of these things. Again, firm-specific risk is the uncertainty associated with investing in one particular business, whereas the market risk is the representation of the entire market, all the businesses, the stock market, for instance. Another way to avoid risk would be to insure your assets. To give you an example of how insurance works, there's a whole market for this in the financial sector. It's kind of like this. Let's say that I have a pool of people, and all of these people want to spread the risk of, let's say, driving, right? And so we get into cars every day, and we assume we're not going to get in an accident, but we could. And so if I do get in an accident, rather than absorbing the whole impact of that accident financially, maybe we can share the risk here so that if, like, say, one person gets in an accident, we all sort of pay into that person's recovery, damages, or whatever. These pool of people, right, and they all have cars, they're going to pay into this insurance, and they're going to pay, let's say, Geico, a pool of money. So they're going to pool their money together and each pay a little bit of money every month. All right, so let's say one of these people gets into an accident. So let's say the accident costs $5,000. Well, let's say this one person that got in the accident, they're going to end up paying what's called the deductible. The deductible is the amount that they have to come up with prior to insurance company picking up the remainder of the money. Now, some deductibles can be high, some can be low, but an average deductible would be around $500. So let's say this person pays the $500. Now this pool of money is going to cover the rest. And so Geico, let's say, is the company. They're going to pick up the remainder of the money, and what they're going to do is they're going to fund the remainder of the money to fix the car. So this person ends up paying $500. This insurance company picks up the remaining $4,500. And that's how insurance works. And you can buy insurance on virtually anything that you own. On your home, you can buy it on financial assets. Wealthy people even insure, like, let's say, a singer insures their voice, or an athlete insures their legs. You can insure almost anything in our economy. One way to deal with risk is to buy insurance. And so what happens is a person that is facing the risk pays a fee to the insurance company, and the insurance company then absorbs the potential risk that is involved in the endeavor. Like I said before, there's different types of insurance. There's auto insurance, there's fire insurance, there's health insurance, there's dental insurance, etc. So insurance is a gamble because you may never get into a car accident. You may never get sick. You may never have a flood or a fire or whatever. So at some level, you might pay into this industry for your entire life and never use it. But you pay it to receive a peace of mind, and that's the ultimate goal behind insurance. So why do we have insurance? The role of insurance, again, is not to eliminate total risk, to spread risk around more efficiently. And economists like to say there's two problems with the markets for insurance. Number one, what's called adverse selection. Adverse selection is the notion that a person that is high risk is more likely to apply for insurance than a person is low risk. For instance, someone that lives on the Atlantic Ocean is likely to apply for flood insurance because they know there's a chance that something could happen that could damage their house relative to a flood. Well, if this is the case, then it's possible that this house would also then have a claim for a flood. And so for an insurance company, this is a little bit of a problem because the revenue generated from that person also puts them at risk of having to pay for that person's potential claim. Or it might be like saying someone that drives really fast and recklessly needs insurance in the event they get in an accident. There's also another concept that we could look at for the problems with insurance market, and that's called moral hazard. Moral hazard is the idea that once people do have this insurance, that they act more recklessly. Okay, now I have fire insurance, so I'm going to smoke a cigarette in my house, and I'm going to leave the cigarette on the table even though it's burning. If it burns, big deal, I got fire insurance. All right, I got car insurance, so I'm going to drive around really fast, and I'm not going to pay attention to stop signs and stoplights. Okay, I got life insurance, so now I'm going to jump out of a plane at 4,000 feet. No big deal. All right, again, moral hazard is the idea that people, once they own the insurance, have less incentive to be careful. Now, these two things affect the price of insurance. And I have a couple pictures here to show you how this works too. All right, this is the area that I'm from, which is southeast Florida. And this is along I-95 south going towards Miami. And you can see that there is markedly more individuals in their automobiles than in this picture here. So this picture is very likely to be one of my commutes on a day-to-day basis to work back when I lived in the southeast Florida region. So this picture to the right is a picture of my commute today. And so this is off of 82 out there, by 95 by the Oasis. And so you can see that there's just not as many cars. You've got 8 million people that live in the Tri-County area of South Florida. You've got 80,000 people that live here. One of the things that this is going to reflect is the price of insurance as a result. And so over here, we have a lot of people. The likelihood of an accident is high. Well, insurance is going to be more expensive. Over here, a lot less people. The likelihood of an accident is lower. Insurance prices will be lower. My wife and I paid over $500 for insurance when we lived in South Florida. Here we pay about $100. And so you could certainly draw the assumption that auto insurance in South Florida is higher than in South Georgia.